Hey everybody, good to be here today. My name, Brent Moores. Time for long options. If you haven't noticed, I would say the markets have been a little volatile lately. So I want to talk about that today in the context of long options, which is, of course, is the subject of this class, and how we can kind of navigate this perhaps. And I'm joined alongside Connie Hill, who's helping me out in the chat. You can follow Connie or myself on X at Brent Moore CS, at Connie Hill CS for additional content. And also just a little heads up, I did get notice from my internet provider that they may be doing some work in my area, and they didn't give me much notice on that. So if by chance I get cut off, we'll get back up and going within just 2 or 3 minutes here. Connie is prepared to help me out in that case. Hopefully that's not going to happen though. So remember, options do carry a high level of risk and are not suitable for all investors. And the information today is provided for general informational purposes only. It's not an individual recommendation or endorsement of any particular security strategy or chart type. Schwab does not recommend the use of technical analysis as a sole means of investment research. The paper money software application is provided for educational purposes only. And for the sake of simplicity, examples I'm going to go through aren't probably going to factor in commissions, but just realize that's a factor to think about. Past performance of any security or strategy is not indicative of any future result. And let's see, paper money applications don't assign short options early, although we're going to be dealing with long options today. So there we go. Let's do it. Let's head on over to the Thinkorswim platform. I'm going to bring up, and let's just do a quick market check, because I'll tell you, frankly, the markets lately, you look at it and 10 minutes later, it's changed so dramatically. I have the S&P 500 index here, and you can see, we've been kind of in free fall here. Assume at some point we'll get a bounce. Right now, we haven't seen that. In fact, if you look at this candle, look at that last candle. Where are we on that candle? We don't even need to zoom in on a daily candle. You can see we're right at the bottom of the day. So that is just showing continuing bearish momentum. And when there is more uncertainty in the market, implied volatilities are higher. Okay, and I want to talk about implied volatility today. I want to talk about Vega as well, which is the Greek that is associated with implied volatility. And I want to talk about how they impact your long option portfolio. So that's the goal here today. A way to measure implied volatilities on the market as a whole, and a lot of you are aware of this, is to just look at the VIX. The VIX is looking at implied volatilities on S&P 500 options. So what is implied volatility? Implied volatility is just a measure of options pricing, and option pricing is higher. That is, the price to buy a call or the price to buy a put is higher when there's more expected movement in that option. Okay, so we can see there's more expected movement in the markets right now. We can see that from the VIX. And you can look at the implied volatility on any individual stock if you want. So for example, let me just pull up Microsoft, just a company that everybody knows. Let me get rid of this left-hand column here. Here's Microsoft. If I want to pull up implied volatility, I have it quick linked right here, but you can go to the Flask and just put an implied volatility there, and you can see implied volatility. Okay, let me go back a little bit in time here. I'm going to go back 3 years, and you can see that implied volatility goes up and down. And very often the implied volatility is tied to earnings. This is an earnings report. You see that little blue and red? That's an earnings report. Notice implied volatility before earnings typically goes up and then it drops after. It typically goes up and then it drops after. That's because there's more uncertainty about more expected movement in those options heading into earnings. And then the earnings event comes out, the stock goes up or down, likely a fair amount often, and then there's less uncertainty there. So the implied volatility goes down. And you can see that process repeats itself, more so on some stocks than others, but that's a general process there. And so that is, it's showing the pricing of options. That doesn't mean the options are not priced, that you need to avoid options that are more expensive, because keep in mind this, it's pricing in what the expected move is in the options. Maybe it's pricing it improperly, properly or improperly. I don't know. If it's proper, if the expected move is high and the move actually is high, then there's zero problem doing long options there. The problem becomes more if you expect a higher move and you have a higher implied volatility, and then the option doesn't move concomitantly with that. That's the problem. And so that's a challenge. That's a challenge for us here. But let me bring up, and we're going to talk about dealing with that challenge in just a little bit. But let me mention this for a sec. Okay. Sometimes you may hear of something called historical volatility. So I'm going to pull up historical volatility as well. So here's historical volatility. I want you to compare the two here. I want you to look at, again, we'll look at Microsoft. Here was that earnings that I talked. Here's earnings that I talked about, and you can see implied volatility had gone up and then it dropped after. Look what happened to historical volatility. It was there and then it went up. Okay, let's look at another one. Here was earnings. Implied volatility kind of went down after. What happened to historical volatility? It went up. Kind of weird, isn't it? Why is that? Well, as I mentioned before, implied volatility is expected future volatility on the option. Historical volatility is actually looking at the stock itself, volatility on the stock itself, and it's not expected future volatility, it's past volatility. And so once we have the earnings event, what happens to the stock? The stock moves a lot, typically. And so if we're looking at what the past volatility is, and we've just had the earnings, that the movement is going to factor in that historical volatility quite a bit. For the most part, we don't look at historical volatility that much. And the reason is because we don't care as much about the past as we care about what the expected future is. And the one that's going to affect those option prices is that implied volatility to a much greater extent there. So there we go. Okay, hoping that's clear. Okay, now, when we talk about options, one of the things we will talk about is Vega. Let me just pull up some options here. And I have a column for Vega here. If you don't have that column for Vega, you can click on up here and you can pull up what you want. Okay, Vega. All right. So here's Vega. And Vega is a measure of how much the option is expected to move per point move in implied volatility. So if implied volatility goes up, we're going to expect that option price, we'll just pick, say, the 375 for our example, this 375 call, that option price to go up about 47 cents. Well, right now it's about 18.15. Add 47 cents to that, that's telling you an idea of how much that would go up if implied volatilities go up. And similarly, if that if it goes down, that's how much we'd expect that option price to go down. Okay, so if we're doing a long option, if we're buying a call or buying a put, everything I'm going to say is going to apply to put here. If I'm buying that option and implied volatility continues to go up, great, that helps. Everything else being equal, that helps the option. But what if we have that volatility drop, a significant volatility drop? Then it can certainly hurt our long options. In general, what we're going to say, though, is long options are benefited with implied volatility increases. Short options benefit if implied volatilities go down. And so in high implied volatility environments where you expect, well, it's kind of high, maybe it'll go back to what it's been in the past, lower, then a lot of people will favor short options, okay? So that's great, and I don't have anything to say against that. The short options can it can be one solution to the implied volatility problem, to this volatile environment problem, but it's not the only solution. We don't need to run from implied volatility, high implied volatility. There's ways to minimize that vega. And to show that, to demonstrate that, let me just show you this. I'm going to bring up let me bring up more strikes here. Okay. And what I want you to do is I want you to look at this vega column. And right here, that's theta. Here's vega. Notice where the highest vegas are. Well, they're right here, around 48. 47, 48 is the highest vegas. Okay. Where's the at the money contract? At the money contract is, well, right around 380, right here. This is the higher implied volatility contract. Excuse me, this is the at the money contract. This is the higher vega contract. As we tail off more in the money, or we tail off more out of the money, vega goes down. The sensitivity to volatility goes down. So one strategy to try and maybe minimize the implied volatility impacts on your option is to go to either further out of the money contracts or more in the money contracts. Okay. All right. And Paul, I'll get your question answered there. I know Connie was trying to help you out with a video. I'll get to that in just a minute, okay? That's one strategy. Yeah, that's one strategy of trying to minimize vega. Okay, let's do another thing. Let's do another little experiment on this with vega. And look, not just within 1 month, but let's look at different months here. So let's go out and we're going to look shorter time. We'll go out 10 days. We'll go out 37 days, and we'll go out 129 days. I'm just kind of randomly picking at those. And we'll look at the 375, let's see. Well, we'll go right at the money, 380. Okay, let's look what the vega is. Vega is 25 here. Oh, vega is like double. If we go from 10 days to 37 days, we've just doubled vega. Okay, if we go out to 129 days, we're out almost double again there. We're almost out double again. So in other words, if we want to reduce vega, in addition to looking farther out of the money or farther in the money, we can also look at contracts that are closer to expiration. That can minimize the effects of vega or implied volatility on your contracts. Now, I want to look at some examples here. Okay, and we'll just kind of go through and show you, just, to give you, I like to give you these sample trades. They're not recommendations, of course, but as you're learning options, as you're learning long calls, learning long puts, hopefully it's helpful there. So let's go to a chart here. Let me just clear off this chart for 1 sec. And one of the questions that you guys have is, oh, look, Brent, you have these little links up here on the chart. How do I get that? Well, it's a couple-step process. One of them is go to the gear right up here above your chart settings. You should have that gear up there. Click on that, and you got to go to My Tools right here. My Tools, and I'm on each chart. You can also do it as a panel off the chart as a separate window if you like. But these above my chart, you go to on each chart there, okay? So there we go. And then when you have that, you'll have another little gear right over there, okay? Right over the gear, you click on that gear, and then it gives you the choice. I already have a bunch added there, but let me just see if I can shrink this down a little bit here. And so I have these added here, but one of the choices it'll give you is to add a button on this. And my resolution is changed on this screen enough that it's actually off the bottom of the screen there. But because I've made this all big so you can make it big so you can see it. But there's an add button. And one of the nice things, you can add study sets, you can add styles, you can add time frames. And so, and there you go. Okay. So hopefully that answers that question. Now let me answer other questions. Here, let's see. And that's for a debit because credit is, okay. So Agariba, I'm not sure when you're talking about debits. Okay. So the ask price here is what we're, for a debit transaction is what I'm talking about. Long calls, long puts, those are debit transactions. And so if you have a long call, long put, positive theta, that means the implied volatility, an upping and increasing of implied volatility is going to help the trade, and a decrease of the implied volatility will hurt the trade. The opposite is for credit spreads, or excuse me, credits, short call, short put. When you have spread trades, generally you have one long contract, one short contract, so they partially, at least to some extent, offset each other there. Okay? So let's look at some possible examples here. Okay? So I'm going to pull up AMD as an example, and I'm going to do our normal technical analysis. Okay? Our normal technical analysis. And that technical analysis is, right now, I think a lot of technicians would look at this and say, what's my trend? That's kind of number one. Our trend is down. Okay, our trend is down. Number two, I want to kind of look for things like support and resistance, and then I want to look at price action. Okay, so we'll call price action. So those are going to be the main things we're going to be looking for on this technical analysis. So just to make it a little bit easier to see, I'm going to zoom in just a little bit. There we go. Our trend is down. We have a series of lower highs and lower lows. We kind of have this thing it's doing, and that is, here's our highs. It kind of keeps flagging is what we'd call it. It goes down and then goes sideways or up a little bit. Okay, down or sideways, in this case a little sideways. Down. Now it looks like we may be bouncing down right now. So what I'm going to say is the trend is down, potential maybe resistance here, no support in sight, at least on this 9-month chart. And so I'm going to look in this case at a bearish trade. In other words, a long put. Okay, I'm going to look at a long put. So let's look at long puts here on this, and kind of put in the principles that we have in place here that we mentioned. Remember, the longer, if I'm doing kind of a trend trade, when a couple months ago or so, maybe even 3 months ago, I'm not sure, a couple months at least, we did a kind of a sample trend trade plan where we went through long calls and long puts, trend trades. And one of the things we said on there is we said, well, we're going to look at like maybe 50 days out or something like that in terms of expiration. And we said maybe we'll look 50 to 60 delta, I think, on that. So in this case, if I shorten this a little bit and I go to the higher delta, that could help us in terms of the implied volatility effects. Now, one thing else I should mention, if the market goes down and if stocks go down, that tends to help keep implied volatilities high. If the market, say, reverses itself and the market, all this volatility, the market does well, then that implied volatility is gonna mellow out if the stock mellows out here. So what I'm going to do is I'm going to go out. Instead of going to the 50 to 70 days out, I'm going to make this a little bit shorter term. I'm going to go out to April 17th, 37 days. That still gives me a while for things to work in our favor, hopefully. If AMD continues to go down, it still gives us some time to work. But I'm also going to do this. I'm going to the puts, and I'm going to do something that's a little bit more in the money. So let me just get a few more strikes here. I could go all the way to like this 110 strike. That's significantly in the money. That's like almost an 80 delta. Maybe I don't go that far. I can go 68 delta. You can see our implied volatility, it's a little less there. Mostly though, let me just compare this to our 66 days out though. and compare our, I said Delta, I think I meant Vega. Here's the Vega for 66 days out. So we're certainly substantially less here going out this far here on this. So I'm just going to do the 105. I'm going to click on this, ask price. Let's talk about stops on this. Where should we put our stop? Well, what I'm going to do is sometimes we do put the stop based on the stock price. We can certainly do that. We can also just put the stop as a percentage of the option. So if I wanted to do that as a percentage of the option, given that I went in the money, I think it was a 68 delta. Generally, so let me just write that down. I think it's a 68 delta we were just looking at. Generally, the higher the delta, now remember, delta is just a measure of how much the option is going to move in relationship to the stock price. But we can also use it as kind of how far in the money. Generally, the higher delta, you can have a tighter stop. In other words, if I have like a 50 delta, my stop may be more like 50% of my entry price, okay? That's my entry price. But if I have something closer to 70 delta, maybe I'll go like 70% of that. So if I take 1110, that I'm just looking right here, 1110, multiply that by 0.7, I come up with 777. So I'm going to say 780, and I can do a stop there on that to try and cut our losses if we're wrong and it goes against us. Now, stops aren't guaranteed, of course. I can change this to first trigger sequential order. I can right-click on this. I can create an opposite order. There we go. And just double check. Quantity's 1 here. You can do more than 1. Just make sure you know what you're doing. And this is going to be not a limit. This is going to be a stop. And I'm going to make this not 1120. I'm going to make this 780. This is a tighter stop loss based on we did a higher delta on this, a more in the money contract on this. Now, I probably, in this case, for our purposes in this class, we're not going to go tighter than that. Some of you say, well, I don't want to lose that much. Of course, and that's not even guaranteed. We can certainly lose more than that. But the point is, options are volatile, folks. Especially in this market, options are volatile. And just an intraday swing, we can see that volatility here on this. So just as an example, let me just show you this. Let me just right-click on this, and I'm going to copy that symbol. And let's look at our chart here for that symbol. And let me just kind of zoom in. So here's the last, couple months. And you can kind of see the differences in prices on this. I mean, on this day, we went all the way from $11.50 down to $7 in terms of the swing, okay? In terms of that swing. That $11.50, so I don't know what percentage that is, but that, that dropped down, 30% in a day, a single day. Typically, you don't see that on stocks. Okay? Typically, you don't see that on stocks. Options are more volatile. And so that's why we can't put that stop that tightly, as tight on an option as you can a stock. Now, stop, it's going to be good till canceled. And my entry price, natural price is 1120 right now, 1125. We may be able to, the natural to mid is pretty tight. That's good. That means we have a liquid option. That's a more liquid option. So that's great. And what I'm going to do is I'm going to confirm and send, and we're going to add that to our single options portfolio there. Okay, fair enough. So that is, that's one trade. Well, let's look at another trade here. Let me do this. I'm going to go here, and we just filled on that, by the way. Okay. Wait a second. Did I see a sold? Let me just working orders. Did I mess up on that? Oh, I didn't change the Somehow I messed up and didn't change the price on the stop. Oh, Brent. Silly Brent. Okay, that is, well, there's your example, folks, of why you need to take your time on this. Let's do this again. We went to, I think, the 105 strike, and I'll show you what I did wrong. Okay, let's buy custom with stop. And Lisa said, can you double check your stop on that AMD trade? Yeah, now I am, because I just wasn't very smart on that, was I? This stop was supposed to be at 780, okay? I put it in right where we're at, so we entered and exited right away, okay? There's the proper stop. So thank you, folks. Sorry. This is a good reminder, though, to, it's a good reminder to read this page. I should have done that before and gone, look, here's our entry, here's our stop, 780. And then when I send this, there we go. And it hasn't filled yet, but we'll let that work. Okay. All right. Good catch, guys. Thank you. Sometimes I lose my brain when I'm out teaching everybody here. Okay, let's do this. I'm going to go to our charts, and I'm just going to pull up the NASDAQ. Okay, here's the NASDAQ, and you can see, let's do intraday here. Here's an intraday chart on NASDAQ. This is what we've been doing today. Just keeps on going down. You know, when we've done, when we look at technical analysis, I mentioned flag, down, sideways, down, maybe a little bit. I'm going to assume that we're still going to continue down here on this. So there's two separate trades. Let's look at one other, even if we don't submit it. Let's do this. Let me go here, and I want to point out something to you. In this class, we've done many trades. We got stopped out of Visa today. Okay, we got stopped out. Visa has been a wonderful trade for us. If you remember last week, we discussed moving that stop up. So let me go back up here. Let's look at Visa for a sec and talk about maybe doing a replacement trade on Visa. So let me go back a little bit more time here on Visa, and we'll go, I don't know how long we've been in this, but let's go back, I don't know, 120 days here. Okay, we bought this for $50, okay, back in January. We bought it for $50. We got stopped out today, okay? That's because we tightened up that stop. We put that stop at 60. So we walked away. The sad thing is we actually would have made a lot more if we got out earlier on Visa, but we did that stop and it got us knocked out. Okay, we were saying this moving average, I think we put the stop right around that moving average. We said if it breaks the moving average, we're out, and we're out. So we captured a little profit, not as much obviously if we stayed here. The only other thing we could have done is we could have put our stop a little tighter, maybe below our support level right there. Okay, that would have been a possibility. But why did I not do that? The reason we didn't do that was the stated objective of this trade was a long-term trade. This was a LEAPS option. This option did not expire until June of 2026. So we were trying to mimic this on a stock trade and a longer-term stock trade, and that's why I didn't have the stop quite as tight. But at this point, we're out. Let's look for another possible LEAPS option here. Now, LEAPS, this is kind of maybe going a little contrary to what I was saying before. When I said, look, the closer you go to expiration, the less that implied volatility is going to affect it. That is true. So our Vega will be higher. But if we go in the money sufficiently, it may not be as big an issue. I'm going to call this, for our purposes in this class, a bullish trade. Our stock, it was not good at all. We had this downtrend, but subsequently it looks like we've bottomed out. There's a low, higher lows, high, lower high, but then we've had higher highs. This looks like an uptrend here. We're above both our 20 and our 50-day moving average as well on that. So I'm going to look for a leaps option on this. Let me go out here. This is just a longer term option. I'm going to go out about a year on this. And what I'm going to do is I'm going to go in the money, substantially in the money here. Because remember, look at our Vega here. Our Vega for our at the money is 37. But if we start to go up here, it's like 12. If we go, now this is about a 90 delta. 90 delta is, you maybe go, there's pros and cons on a 90 delta. That's right here. Pros and cons going in that money, in the money lot. The con is it's an expensive option. One contract, if I go at that ask price, is $3,850. But keep in mind this is a 92 delta. A 92 delta means every dollar move in the stock, I'm getting 92-cent benefit on this. If we compare this, when we say, well, $3,800 is a lot of money, but compare that to buying the stock. The stock would be about $9,500 or $9,400. Excuse me. 94. I put my decimal point there. That'd be about $9,400 for 100 shares. Okay. Jerry said, I thought we said Visa. It was Visa we were looking at. This is a different trade. Okay. We got out of Visa already. Okay. This is Colgate-Palmolive. I may have said Visa, but I meant Colgate. Okay. So this is the one we're looking at now. So as compared to buying the stock, it's roughly, it's well less than half the price. Okay, well under half the price of buying the stock. But we're getting 92 cents on the dollar in terms of movement. And if the stock goes up, that delta is probably going to only go up from there. So very different than our shorter term options. But by going deep in the money on those, deep in the money leap on that, we're able to place the trade and have the effects of implied volatility be a little bit less here. So what I'm going to do is I'm going to right click on this. I'm going to buy custom with the stop, and I'm going to put the stop based on the option price, on the stock price. I'm going to say, I'm going to target this 20-day moving average right now because it's quite a ways below where this recent bounce was as well. And that recent bounce was around $90.50. We're going to say if we go below there, we're going to get out, $90.50. So CL, I'm going to make this market, good till cancel, click on my gear. We're going to say, we're going to get out if we mark less than or equal to 90.50. And this will be our last example trade for the day. And there we go. Okay. And this is, well, that should fill. My natural price here is 38.50. So I would think we'd probably fill on that. I'm going to confirm and send. I'm going to put that in our long single options there. Okay. All right. So would I sell a shorter term above the price of this? So Jerry's saying, could you sell a shorter term option? Yes, you could. That's what we call kind of a poor man's covered call in a sense there, Jerry. That's a spread trade, which is kind of outside the scope of this class. In this class, we typically just do long calls and long puts, but you can make that a spread. And if you did, you would lower the initial cost of that trade. That's absolutely, but we'd also be limiting our gains too. So there's pros and cons on those. And there you go. All right, everybody. So thanks for joining me today. Appreciate you. Thank you, internet provider, for hanging in there. And thank you, Connie, for helping me on the chat. So I will see you all same time next week. Make sure you subscribe to the Trader Talks channel. And feel free to follow Connie and myself on X at Brentmore CS, at Connie Hill CS. Andre says, how long will we be in that trade? The answer is, as long as the trend is going up. Okay, so I'm not going to exit. I'm not going to put in a target price on that. And I'm not going to put in the target price on that. We're just going to let that run as long as it goes up. At a certain point, when we get closer to expiration, we will look to exit. But there you go, everybody. Hey, thanks for joining me. Have a great, wonderful day, great rest of the day. And we'll see you later. Bye-bye, everybody.